and I mean the other stuff coming up as well. We've got 1150 stocks which are higher and about 400 stocks which are down, and the rest of the market is opening up. So it's kind of very, very mixed out there, but more up than down, at least on the Nifty, as you can see up on the heat map. You know, that'll also change. Advanced decline is 2:1 in favor of advances, at least with respect to what's opened up right now. Surbi.
Okay, on the large cap screen, you've got Bajaj Finance up 2.5%. So the market's being optimistic, not getting too perturbed with the slight rise in credit costs and the gross NPA increase, because the guidance is that this will sort itself out. They are not sounding very alarmed on it, and the market's kind of taking that. Even Bajaj Finserv is up about 1.5%. Other gainers include Bharti, BPCL, NTPC, Hindalco, Coal India, there's BEL. So very mixed trends. A couple of consumer stocks like Britannia and Tata Consumer are also okay for the time being. Now on the downside, look at Tata Motors, 8% down. This margin thing, the market was just not prepped for this kind of a margin decline. Blended basis and the JLR margins, 7.5% lower on that stock. Sales, we know that, it's been very sluggish, but margins, oops. Wipro, about 1% lower. Infosys is slightly lower as well. L&T, ahead of numbers, is about 0.25% lower. Then you have some of the larger banks like ICICI Bank, Axis. They're all very cautious, slightly negative to flat. Kotak is flat. Let's see what HDFC Bank is doing. It hasn't made up its mind. HDFC Bank is totally flat. Reliance is totally flat. So depending on what let's look at Lever. Hindustan Unilever is also, it's up about 0.5%. So consumer stocks relatively better, but depending on which way the big boys decide to go, we'll have a clearer direction on the Nifty. But the headlines are all beyond the Nifty, Nigel, aren't they?
Well, that's right. A few stocks in the broader markets that are up and about. ACME Solar, I think yesterday the stock was up 10%. Today it's up another 10%. So big move is what we're seeing out there. Sigma, I think you mentioned that one. It's up close to around 7%. It's following on yesterday's big gains. KPIT Technologies, we'll speak to the management in just a bit. Beautiful move up there. The stock is up close to around 6%. You have Suzlon Energy up 5% yesterday. Keep in mind, it's seen a sharp correction from the top. Management is sounding optimistic, though, about business prospects. So that as well has popped up in trade. And Anantaraj, after getting smacked in the last couple of trading sessions, pulled back yesterday and pulled back some more today. So that stock as well is one of the top volume movers in trade today. I think,
Hitachi Energy, 14%. Beautiful numbers, and the stock is flying. It's off to the races. And now that we have final rates on Whirlpool, maybe we can pick that up. There's just a complete, seller's frenzy right now on Whirlpool, 20% down, straightaway circuit.
A couple of other stocks as well. Blue Jet Healthcare, I think they came out with a set of numbers. So volumes are around, I think, close to around 2 lakh shares traded in the first minute. It's up close to around 10%, so you can't get in if you want to. That stock, it's closed out there. Brigade, I think you mentioned as well. Car Trader is another one that's up close to around 10%. So decent looking screen as we speak. So a lot of winners from the broader markets. Whirlpool is the disappointment. Techno Electric is down 11%. Voltas is taking it hard. You have, JK Paper as well lower. Eclux is down close to 6% volumes, though not very, very high. And from the stocks that I track as well, Jindal Stainless, the numbers on a year-on-year basis, it looks a little bit softish, but it's more or less in line with what most brokerages were looking at, whether it was Phillip Capital or it was ICICI Securities as well. It was more or less in line.
No, absolutely. And
Netweb, have you guys seen, by the way?
No,
Netweb is
up,
another 9%. Yeah, Netweb.
Yeah. No, I think, market, I mean, of course, it had corrected the most from 2,500. It had fallen to about 1,400 or so. And I think it's seeing a bit of a reversal to the reversal in that sense, right? So lots happening, and I think we'll continue to bring up individual names, etc. more. Gautam Shah is with us, founder and chief strategist at Goldilocks Premium Research. Gautam, good to have you with us here. Good morning. Thanks very much for your time. The market structure seems to have weakened, and we are down now. Although we off about 300 points in the Nifty from the lows day before yesterday. What's the broad sort of price action and technical view from here? Near to medium term, Gautam?
Good morning, Prashant. Well, I think the key question that a lot of people are trying to answer is whether this is a correction within the larger bull market or a full-blown downtrend or a bear market that's going to continue for many quarters to come. I think the biggest disconnect for most market participants in India is, for the first time, India has gone completely off track as a market. And you have the world staying very, very strong and in a bull market, whether you look at the US markets or the European markets or the Asian markets. I believe that this is still a correction within the larger bull market because I think we saw a massive run-up for about 18 months. And in that context, I think this fall is still quite normal, even though a lot of people might not want to believe the same. The real damage has really been in the broader markets because the average decline, the whole of NSE is about 28%, whereas if you look at the Nifty itself, it's fallen about 12%. I do believe we've come to a point where sentimentally we are oversold, technically we are oversold, and based on bread data, we are very, very oversold. So a deeper cut from current levels looks unlikely. It seems as if the market is stabilizing. 22,800 was and remains a very important support. We've seen some stability from that number in the last 2 days. And if the Nifty can build up from here and possibly get past 23,350, 23,500, I think all can be well very soon. And because all of our problems have been homegrown, I think what happens on the 1st of February, I think will be very critical to the overall trend of the market. So I would be optimistic. I think from a risk reward perspective, the downside from here is very limited, but as an investor, I think the upside potential is quite large. So I would be constructive from here. I think the downside is limited.
That's good to hear, Gautam. That's really good to hear. And you actually partially answered the next question that I was going to ask you. So if you could just elaborate on that, because you're saying the upside potential is large. And that's what I wanted to understand. That while the downside is protected, can we really expect a sharp reversal? I mean, the Nifty is down about 13%. So are you expecting, in the market last couple of years, it's always been a V-shaped recovery. This time we were wondering whether now you get into a longer time correction, maybe not price. But you seem to be suggesting that no, it's going to be better than that.
See, I think for the last 4 years, since the time we started rallying from the COVID lows, every time there has been a correction, we've seen a V-shaped recovery. I wouldn't be surprised if something similar happens. It's not that we've not seen corrections in the past. I remember late 2022, we had an 18% fall on the Nifty. Everybody questioned the bull market, questioned the fact that India is going to underperform, and then we came back very strongly. I think something similar can happen because I think India will have to be aligned with the rest of the world. So I think the upside potential is very large. Again, if I look at the markets from an 18-month perspective, I think there is potential 20% upside from where we are right now. And the reason I say this is because the weekly, monthly charts are all in great shape. We needed a cool off. We saw a bit of a madness, the SME space, the small cap space last August, September. All of that has cooled off. You can buy stocks at your prices, which you never got in the last 18 months. So I think from a charts perspective, your maximum downside is about 2 to 4% from here, and upside is about 20%. So as an investor, I want to plan for the same.
20% upside over the next 18 months. This is on the Nifty, you're saying, right?
Yeah, that's correct. I think over the Nifty, I do see a possible 20% upside from here. And with global markets continuing to be very strong and with the US Dow at lifetime highs, I think the going is going to get better there as well.
Okay, we've got a headline there. 20% upside on the Nifty over the next 18 months. Nigel?
Okay, all right. Hi, Gautam. And good to hear you're sounding far more optimistic. So that's good news. I like the way you put it. Downside could be limited from here. There could be some downside, but you're potentially playing for the upside. So you'd like to be part of the uptrend. What are the stocks that will take the Nifty higher from here on?
See, I think a lot of people have been questioning the valuations. Honestly, we've come to a point where valuations are very comfortable. I mean, I'm not a fundamental analyst, but what I hear and what I read and what my team tells me, I think at current levels, we are pretty much at average valuations. And therefore, if there is one pocket that can really surprise on the upside, it's the financial services. I think there is a financial services index, which has banks, NBFCs, and insurance companies. I think we like that entire pocket. Bajaj Finance, as you all know, has been a favorite for a while now, and happy to see what it's doing today, and I think it's going to get better from here. And some of the top banks like SBI, SDFC Bank, ICICI remain at long-term support. So I don't see much damage coming in there. And if these three big boys were to start doing well from here, I think the Bank Nifty and the Nifty will do well. So the broader financial services basket is something that we are betting on if the market has to recover from here. I just want the Nifty to take out 23,350. I mean, that's my only marker number on the upside. Once that is cleared, I think the bulls take some control. On the other hand, auto is another space that we like. Real estate, I think, has a very good risk reward. And I think metals is something that we've liked for long. And I think the downside from here is limited as well.
Okay. On that point about the budget, I know it's not a technical price action question, Gautam. But isn't the mood sufficiently bad that even if the budget were to disappoint, that should not act as a fresh trigger for a sell-off?
markets are all about expectations and discounting. And because the expectations are so low, given all that has happened in the last couple of years and the double whammy that we got last year, that I think that 1st February can only get better. And with the markets open, it better be better. So I do believe that, since our issues, the slowdown and earnings, the downgrades and all of that has been homegrown, I think the government has a task. And I hope over the next couple of weeks with the budget and the RBI policy, any positive surprise and the market will lap it up. And I think you will see the change of screen instantly.
It's that season where everyone's trying to predict the mind of the finance minister. I was speaking to someone, from the tax world this morning, and they were saying, no, it's going to happen. The middle class has not gotten anything so far. It's been either the upper class, because the surcharge rate was lowered, or the people at the bottom of the pyramid. Middle has got nothing. They're saying it's going to happen this year, Nigel.
The chatter on social media was quite interesting. I put out some F&O data and all. People are replying to me, Nigel, are we going to see the Nirmala ma'am candle? They're calling it the candle. In case she doesn't disappoint, then they're talking about, this is a new one.
Nirmala ma'am candle.
Candle, yeah, the upward candle. You talk about that one.
It has to be a bullish candle, though.
And a lot of people, and some of them are not replying on Twitter, they're replying personally as well. So I was like, this is a new one. And these are 2 sessions ago. So for them, actually, that candle is taking place. Thoda upar.
Gautam, my question was actually the opposite. Not whether it will surprise on my question is if there's nothing in the budget,
then will we fall more?
Can it act as a trigger for a fresh fall? Because the mood is bad. That was my question.
It looks unlikely, Prashant, because I think most of the negatives are now in the price. I think the kind of decline that we've seen in the broader markets, there has clearly been panic on the screen. The bread data is terrible. Percentage of stocks trading off the 50-day moving average, 200-day moving average. Yeah. And, we handled capital gains and STT so beautifully last year. If we can handle the worst possible news flow, that's probably the reason I'm saying that it can only get better. It can't get worse.
Okay, I love the optimism this morning, Gautam. So I think all the bulls are going to be with you, and they will wish and pray that what you're saying really comes through on the budget as well. But getting back to that thesis, because your thesis is 20% up on the Nifty next 18 months, so it's a great time to start building portfolios. Tell us what would be your top longs then in that case?
Well, as I just said, that financial services is something that we like. I think, if I'm not wrong, the Bank Nifty now trades at a PE of about 13, 14. Many of these stocks have been hammered without no logic, and they're all trading at beautiful long-term support levels. So I think financial services will make a top comeback, followed by the IT sector, which I think has seen a lovely breakout on the ratio charts. And I think they've been quite resilient. I'm referring to the top IT names. And I think auto as a sector, auto and FMCG, and even PSU, these 3 baskets, which have seen a very large fall over the last 6 to 8 months, can also come back. And mind you, if you look at the mid caps and small caps, they have been in a consolidation or a time correction for almost 8.5 months. They've come to a point where the risk reward for top quality mid caps and small caps is once again lucrative. Again, please look at the context of the rise in mid caps and small caps in the last 2 years. Many of these stocks were 3x, 5x, 7x. If after that they lose 30% from the highs, as a technician, I would still consider it normal. So anybody who got into the market in 2024 must be complaining. But if you have been invested over the years, I still feel that this correction is digestible.
Okay, all right. That's a good optimistic note to have just, days ahead of the budget. Gautam, appreciate it. Thank you very much. And we look forward to connecting again. Let's see what happens on Feb 1, and then we'll pick it up from there. Thanks very much for the advice this morning. Well, that's, the Goldilocks research on the market. Market's absolutely flat. Nifty's doing nothing, just about 11 to 12 points up. Lots of numbers and lots of earnings reactions have been pouring in. So let's look at the next company. Blue Star is the next management on our show. The company reported a pretty good set of numbers for the third quarter. Revenue and PAT were in line with the estimates. Margins actually were above the street poll as well. Growth was led by the EMP and the UCP segments. We have with us Mr. Veer S. Advani, Chairman and Managing Director at Blue Star, joining in to take a couple of questions. Mr. Advani, great to have you on. So, both the segments that I just mentioned, they've really been on a great curve. And even overall, if I look at the blended number, the revenue is up about 25%. The margins moved to 7.4%. So let's start there. Is this kind of a solid show sustainable, specifically on the margins?
So good morning. Thanks so much for having us, and thank you for opening with that. We've had a good quarter. I think you saw revenue grew 25%. EBITDA has grown 35% to 209 crores. EBITDA margin also improved. You would have seen EBIT improvement in segment 2. We moved from 7.1% to 8.1%. That was primarily on account of volumes and economies of scale. And then you saw in segment 1, which is our projects and commercial air conditioning business, very strong revenue growth of 32%. EBIT margin slightly lower at 7.6%, but holding pretty firm. We really attribute all of this to largely due to scale as well as controlling our operating costs.
You know, what's really interesting, Mr. Advani, is that you've done so well in the unitary cooling products, division. Like you mentioned, the top lines have been good, the margins are good, but some of your peers in the industry, I was looking at Voltas's performance in the same segment, and they've faced a lot of margin pressure. So clearly the trends are different between different companies. But let's talk about the AC segment and whether you expect similar growth to continue. So for the year as a whole, what will the growth be, or is this a bit of pre-season inventory filling phenomena that we've seen, and what should we expect from the AC business?
Room air conditioner business, as you know, is in segment 2. We have the commercial air refrigeration business and the room AC business. So as room AC is concerned, it was a good quarter for the industry. I think industry grew quite well. Blue Star also did well. I think a large number of our competitors also did manage to grow some market share. Blue Star on a standalone basis in Q3, we believe that our market share would have touched 14% for the quarter, which is an all-time high for us. We've been trying to get to 15% on an annual basis for a few years now. We're inching up there. Of course, on a full year basis, we will still not be at 14%, but we're very happy with the Q3 result that we had. Of course, there was pre-buying before the season started. That usually does happen in December. But we're expecting a good Q4 for the industry. Obviously for the full year, it'll be a strong growth because it was such a great summer. But on a ongoing basis, we expect the business to grow at about 20 to 25%. For the industry to grow at that level, and Blue Star should grow a little faster so that we achieve our 15% market share goal. Overall demand is good. And of course, there's some headwinds around liquidity and a little bit of consumer uncertainty around spend. That's true of the entire all consumer products, but I think air conditioners have been an exception. We continue to see growth at this 20 to 25%.
All right. Hi, Mr. Advani. Since we're talking a lot about your competition as well, and no doubt your numbers look good. We're waking up today. Your stock is a little under pressure, but you have Voltas that's down 10%, and you have Whirlpool that's down close to around 20%. I need to ask you this. Would you have thought of looking at maybe taking a stake in Whirlpool, since the promoter entity wants to reduce their stake? 75% has come down to 50%. Now they're talking about 20%. And if you thought about it yesterday, today you're getting it 20% lower. So will you all be looking at it? Because you get 30% of some competition here in India.
So frankly, I think we've explained our long-term strategy to you and to the market. Yeah. We are a focused air conditioning, refrigeration, and heating company. We have global ambitions. We don't look at just India as a market. We look at the Middle East, the US, and Europe. So, but we want to stay focused in our area of expertise, which is air conditioning, refrigeration, heating. In that context, moving into consumer durables, a wider portfolio for the Indian market doesn't fit our strategy. And so we're unlikely to make that move. But like we do with everything, we're very keen to stay connected with the larger durables industry. So, we may have a look at what Whirlpool is about, but no intentions of an acquisition.
Okay. Got that. That's pretty clear, Mr. Advani. Good morning, Prashant here. There is just one more thing, not very specifically related to Blue Star, but right. And again, I'm bringing in the competitor Voltas here. How is the view now evolving of actually, outsourcing some of the manufacturing to making it in-house? Because Voltas moved it in-house. Could you give us a sense, some perspective? I mean, from an investor point of view, actually, if anything, it's not really helped them in that sense. How's the view evolving on this?
So, we have been a manufacturer for several years now, so now several decades. So for us, it is part of our strategy. It is integral to our growth plan. I think that we've talked about this before. It is very difficult for any organization, Voltas or any other company, to transition from a buy-sell to an in-house manufacturing business model. But it is a transition that all companies are taking and need to take. So I think as far as our competition is concerned, we expect that over a short period of time they should get that whole operation under control. There's no reason why they would not be able to do that. They are an engineering company just like us. So I'm fairly certain that they'll get that right. I think it's the right decision that they have taken to move away from contract manufacturing to in-house manufacturing. There is value addition, there's quality control, there's inventory management, there's so many benefits of it. So I think it's the right decision they've taken. It may just take them a little longer to stabilize that operation. As far as we're concerned, our investment plans, we have two large investments that we're making currently that are underway. One is an expansion of our own room air conditioner production volume in Sri City. We're commissioning phase 2, and then we'll start phase 3 very soon. The other big investment for us is in commercial air conditioning. You may know we've not made a capex investment in manufacturing in commercial air conditioning in some time. So we are now doubling the size of our Dadra factory, where we manufacture VRF systems, ducted systems, and heat pumps. So that's another big expansion for us. So a lot on our table. We have to stabilize these capex investments. We're very focused on return on incremental capital, and that's where we'll stay focused for the coming year.
Okay, all right. So, Mr. Advani, then let's round it up with some numbers and maybe some projections that will help us map the coming year as well. Given that both the AC business, the UCP business and the EMP business both have done so well for you, and you sound quite optimistic, at a headline level, what is the growth trajectory? What should we expect by FY25 end? And blended margins for the company. I mean, I don't know if we didn't get a chance to speak about pricing and competitiveness, but if you could just tell us at the headline level, where do you see margins stabilizing by the time we end this year?
Sure. So it is a hyper-competitive market. Pricing is extremely tight, as you would imagine. Even though demand is strong, every competitor wants to add market share, just like we do. Everyone's made large investments through the PLI, as you know. So everyone needs to get that return in order to collect the PLI. So it's a hyper-competitive market. Pricing is tight. Having said that, on a full year basis, we've always spoken about segment 2 EBIT to be at about 8 to 8.5%. We're confident we'll do that. Segment 1 around 7 to 7.5%. Again, that should happen. We didn't talk about our projects business. That order inflow as well as execution has been good. And so that has also contributed to segment 1 performance. Of course, we're expecting infrastructure demand to pick up as public capex restarts. And we're also hoping that some private sector capex picks up so that we have a strong opening to the next year. I think as far as Q4 is concerned, we're well on track to execute our internal plan. Of course, a lot depends on when the summer sets in. You remember Q4 last year was a very large quarter for the industry. And so we're up against, we have a large base to build on, but we're confident about delivering these numbers. On an annual full basis, I think 20 to 25% is what we're aiming to deliver.
All right, we'll leave it there. Mr. Advani, thank you very much. Really exhaustive conversation and lots of perspective there. Appreciate it here on CNBC TV18 as always. Well, KPIT is the next one we're speaking with. The stock is up 7%. It had a painful last couple of months from 1950 or so to about 1250, which was the recent low in a few months, and back to about 1450 this morning. Now, strong set of numbers for the third quarter. In fact, they've raised their margin guidance by 50 basis points. But do note, the US business has been slow while Asia has been super strong. We have Mr. Sachin Tikekar, President and Joint Managing Director at KPIT Technologies, with us to take some questions. Sachin, good morning. Great to have you with us here, and congratulations on an overall strong set. So you've raised your margin guidance by 50 basis points. Could you tell us what led to the improvement in margins from 20 to 25% over the last 6 months? And what should we expect on a steady state on EBITDA margins in FY26?
All right. So thanks for having me, first of all. Last couple of years, we've been making investments in improving our productivity through artificial intelligence as well as some of the other tools. Secondly, the business mix, more of licensing. These are the two things that we've made investments in over the last couple of years. So some of it is coming to fruition, and that gives us the confidence that to increase the guidance that we have given earlier on to be north of 21% in terms of EBITDA. Going forward, you know how the automotive and mobility industry is. These are turbulent times for the industry, and everybody is all the car makers and truck makers are trying to figure out how to remain competitive. So there, we do expect that in general, they would expect all their partners to do more with less. In order to deliver more with less to our clients, we'll have to remain focused on artificial intelligence, building more solutions so that we can deliver solutions to them in a faster manner, with greater value at a lower cost. We'll try, the effort obviously is to try and do that without impacting our margins. So that's what I could say at this point in time.
Okay, that's useful. But two things. One, will you be able to get to the upper end of the margin, 22% in 26? And second, it's related. From what I've heard, probably not, right? The effort will be to maintain it where you are now, because there seems to be do more with less. There could be some pricing pressure, etc. Are you seeing that?
We have not felt it. In all honesty, I think we have given a higher guidance because we have not felt the pricing pressure, but we know what the OEMs are going through. And as a long-term trusted partner, we are trying to make every effort to see how we can save costs for them. Not just, the cost, the money that they pay to us, but overall cost of their vehicles, and try and make them more effective and efficient. It all depends on how quickly we are able to build solutions and make that transition from a typical services business to a solutions business. So our hope would be to continue to improve the margins like we have done over the last 18 quarters or so. But we'll see how things unfold. I think from the global OEMs perspective, we'll have the quarterly results coming out now for the most of them. Some of them are out as of yesterday, but we'll see more of them over the next 1 or 2 quarters. 1 or 2 weeks. So we'll have a better feel in terms of their strategy, and we'll continue with our long-term efforts to make sure that we deliver greater value to them at lower cost without compromising our margins.
Sure. No, Sachin, it's really commendable. I think 9 months you have already grown the top line constant currency at almost 21% in an environment which has been challenging, where Europe has been going through all kinds of slowdown issues, etc. In that context, let me ask you, the Asia business is really picking up for you. I think you've highlighted that in the commentary as well. Quite a few of the regional markets which you're optimistic on. So is this a conscious sort of tilt that you're chasing more business in Asia and more of the Asian automakers versus Europe, or how does it move? And then in Asia, we had the big headline, right? Honda and Nissan, the joint ventures. So I don't know how much work you're doing for them and what such a consolidation means for a company like you. So if you could throw some more color on this whole Europe versus Asia mix.
No, I think it's a great question. And obviously, the numbers for Asia look tremendous when you look at year-on-year growth as well as quarter-on-quarter growth. It doesn't look all that great when you look at the Americas and Europe. I have to say, so we believe that Asia will be our key growth driver in future as well. Having said that, I have to say that some of the business that we are doing for some of the European OEMs and some of the OEMs in US, we do it and it's run out of India, and that gets booked under Asia. So it's not how it appears necessarily. I just want to say that there is a little bit of a normalization to be done in terms of when you look at the distribution across the geography. Having said that, we truly believe that the growth will come from Asia. And I will come to Honda and Nissan potential partnership. But let me just say this. I think our deal closures have been higher, more than 20% quarter on quarter, which is good news. And the pipeline also is looking much better. And I just want to give you a sense. The highest pipeline is actually from Europe, followed closely by Asia and America. So what you've seen this year in terms of our geography mix is likely to change next year. I think they are likely to have more balanced growth across the three geographies. I hope that answers the question.
Yeah, it does. It does, Sachin. And just a follow-up question, since we're talking geographies,
yes.
US hasn't been growing that much for you, like you acknowledge now. But we have a new dispensation in place, and Mr. Donald Trump is all about firing up, the US auto industry. So again, just want to understand what your current relationships are like and how you would perhaps try to, build on that opportunity. How are you looking at US auto?
Oh, absolutely. And we believe that, so there are two things. One is what the new administration in the US has said, that they want to give more choices to the consumers. What kind of powertrain they pick, whether it's battery electric vehicle, hybrid vehicles, or conventional powertrain. I think that's something that the administration has made very clear going forward. What it means is the OEMs will have to invest, depending on their target market, which powertrains they're going to invest in. And we believe that most of them will invest in multiple powertrains. That means there is a greater opportunity for KPIT to help the OEMs based out of US, to work on multiple powertrains. So that's great news from KPIT's perspective. Secondly, we also believe that the new administration is pushing for more manufacturing to be done in the US. That means the global OEMs will also have to invest more in the US market and increase their manufacturing. That also creates greater opportunity. So we are quite bullish. That's one reason why we are bullish on the US. The second reason is we started to invest in trucks and off-highway last year. And the off-highway businesses started to show some green shoots. And we believe that in the second half of next year, we'll see some growth coming from off-highway, specifically from the US. So that's how we really look at net. We do believe that our business will increase in the US and Americas, and we'll have far more balanced growth than what you see in the current year.
Sachin, just last point, how can we not talk about China, right? China has been all the talk of the town with everything which has been happening. Last time you were on, you were saying that by the end of this financial year, which is FY25, that strategy for China, you said, and China for the world. I mean, in terms of what you're doing there will also kick off. Could you tell us what's happening there?
Absolutely.
Yeah, sorry, go on.
So thank you for that question. And we need to talk about China when we talk about automotive. What has happened is in China, the global automotive, many of the global automotive who were present in China was their number one market. And that's not the case today. So our strategy is to work with some of the Chinese OEMs, also to learn about China innovation, China speed, and also, the ways of doing things. I think there is a lot that we can learn, and we can actually apply those learnings for our global OEMs so that they can become competitive. China, over the last 40 years, they've learned from the rest of the world quite a bit, and they've made some of the things much better. I think it's time that we open our eyes and look at China in a positive way, learn from them, and see how we can help our global OEMs. So that's one part. So we've started working with some of the Chinese OEMs locally to see how they work. And also there are ways through which we can create value for them. So that work has started. We just want to be mindful about, how much we take on in China, because it's a different speed and the expectations of the OEMs there are very different. So we're going to take one step at a time in China, and that's going to be the mantra getting into the H1 of next year, and we'll see what that means in the H2. So we are keeping our ears to the ground to see what is actually happening in China. And at the same time, you hear a lot about trade barriers from, the US 100% tariffs and all software related to automotive is banned now. You've seen increase in tariffs in Europe and some of the other countries. So we also have to make sure that we have a strategy for China, and then there is a strategy for the rest of the world. So we have to strike the right kind of balance between the two.
Got it.
Make sure that there is a rounded growth.
All right, absolutely. A great conversation, Sachin, and thank you for all that perspective on your business and your business in the context of countries and geographies like China, etc. I think we'll hear more about that market as well from you in the coming quarters. Appreciate it. Stocks up about 6% or so. We'll take a quick commercial break here. Next up, you'll hear from the management of Hitachi Energy India. They reported numbers as well. Stocks corrected. High quality name. We have Mr. N. Venu, MD and CEO of the company on the other side.
Welcome back. Well, Hitachi Energy is a stock that's surging in trade. They reported a good set of numbers. Revenue surged up by 27%. Yeah, the margins that expanded as well. To detail the past quarter's numbers and more importantly, what's the outlook, particularly on HVDC, and what's the pipeline out there? We're joined by the Managing Director as well as the CEO, Mr. Venu, who joins us on the show. Hi, sir. Good morning. And always good to speak to you. Congratulations. Margins back in double digits. Will it hold at these levels from here on? I recall when I visited you in Bangalore, you had said it's heading over there, and it's happened. So should we get used to now margins continuing in double digits? And also I wanted to ask you, in terms of this HVDC orders, that's clearly started coming. It's more frequent than what we have seen in the past. And as you said, the pipeline is there. There are 2-3 orders in store. By when should we hear about the outcome?
Yeah. No, I think good morning, Nigel, and it's a pleasure talking to you always. Yes, this quarter has been a very solid all-round performance in all metrics. Our orders have surged almost, high triple digit, 838%, and driven by a large HVDC contract. And revenues are 31% higher, and our margin EBITDA improved by 380 basis points. And our exports have gone up, and our other lever for growth, service, has done well in this quarter in that. Overall, I would say that this quarter has been extremely good in all the KPIs. And as we have been saying about our margin guidance, I think our endeavor is to see that we improve our margins on a quarter-on-quarter basis, or at least hold on to that. So that will remain in that. And coming back to the HVDC, as you know, that energy transition is a huge tailwinds in India. And as a country, as part of the National Electricity Plan, NEP, they want to add another 30 gigawatt of HVDC lines. And that creates a huge amount of pipeline from now until 2032. In addition to what we have won, we see at least another 3 projects are under bidding stage, and we will be also, bidding those things. And if you recall, we have been saying this at least last 2 years, and not only saying this, but we have taken a lot of actions in localizing, our portfolio, localizing equipment, opening our new factory for HVDC in Chennai. All those things are now started bearing the fruits.
All right, got it. So, Mr. Venu, as you said, now you're expecting margins to hold in this vicinity and improve from here on. Is that correct?
At least hold on to that. We don't want to give a further guidance on that. Hold on to that.
All right, I'll have to push on the HVDC path then. As you said, there are a couple of announcements that could be due on that front. And now it's not one big HVDC order in 5 years. The tenure as well, the frequency has increased. Adani, I think they were selected as the developer for one of them, and they're looking for a partner. So, places you well. And if I look at the global backdrop as well, Hitachi, the global company, has been bagging larger number of orders, particularly the one in Europe, in comparison to Siemens. So that places you quite well. What are you all doing so differently that is putting you all in pole position? And on these orders, the Adani order, the Leh Ladakh order, the HVDC order, should we expect it sometime in the second half of this calendar year to know the outcome of that?
Yeah. So I think HVDC technology, this is a technology we have invented 70 years back. And since then we have been, investing in this. This technology, you need a lot of investments required to ensure that you are up to date on the technology, bringing the footprint, low losses, all those things are extremely important. And we did the same thing in India also. And in India today, we almost manufacture or we almost execute this project end to end in that. What we are doing differently is basically, we are localizing it, we are updating it, we are creating the ecosystems in India to execute the project end to end in that. Today, around 16 HVDC links, including the new one. Out of that, 8 are being done by us. So that clearly shows that we are at pole position when it comes to the HVDC technology. And this is also true for globally. Globally, we have done almost 150 gigawatt of HVDC links around the world in various parts of that. And we have been investing, and we continue to invest in this technology in that. When it comes to your second part of the question, I think we at least one more project will get awarded in the next 3 to 6 months also, and maybe another project in the second quarter of second fiscal of the next financial year is what we are expecting it.
Okay, so another HVDC award probably in 3 to 6 months, and the subsequent one in the next financial year. So you mean FY27, sir?
Yeah, this award means the customers will award. It's not that we get everything. The customers will award one project in the next 3 to 6 months, and more project in the second 6 months, second half of the next financial year.
Got it. Okay, so now this becomes really important for us to understand. I mean, look at the stock, by the way. Stock is on 20% circuit. And even though the market anticipated this big swell in the order book, right? We knew about the HVDC order, but still the execution and the rest of the parameters have also hit the mark. Mr. Venu, so if we talk about your order book, total order book, I think you're almost at about 19,000 crores along with this wins.
That's right.
How much is ex-HVDC? And so let's take it step by step. And then you're saying another 6 months, assuming if you get some, something there in that award, how do you see the order book position moving, the total order book, and also X of HVDC? And then we need to understand revenue recognition, because these HVDC orders are very big. So what is the timeline? When will you start recognizing revenue from them? So help us understand both the way the order book will move and how the revenue will start reflecting this.
Right. No, I think, again, thank you very much for your questions. HVDC orders are pretty long gestation period. It'll go from anywhere between 48 months for first half of the things, and next 54 months. That's where we do. The bipole one, 48 months, and 54 is bipole 2. But the revenues will start kicking in slowly after 12 months, slowly, but it'll actually get momentum will come in the second year and third year, and that's where is the thing in that. We don't give the split of our order backlog of 19,000 close to 19,000 crores. What is HVDC? What is not there? But all I can tell you that our order inflow this quarter also, excluding HVDC, also has a high double-digit growth. So that clearly shows our focus on our base orders, our high growth segments I was talking about, the renewable and data centers industries are really growing in this quarter as well.
Got it. So X of HVDC also is growing well. But now the second part of my question, understanding revenue recognition. You said the revenue will start getting booked 12 months onwards. So then help us understand, slowly, gradually. So now help us understand the revenue profile. Some idea of where you might be at the end of FY25. And I'm guessing in FY25, HVDC is not even getting booked. And then FY26, 27, when it really starts showing up in numbers, and what's the kind of delta? And I'm guessing it's going to be a big delta that we'll expect on the top line.
Now, FY25 this year, also we have a revenue from HVDC. That's a Mumbai HVDC project, which we have booked 3 years back. So that's part of the revenue has come in that. So remaining revenue will also come in the next year, and some part of the revenue for the order which we have booked also will start kicking in into the next year.
What's the revenue growth for this year? Top line growth with all these orders and the additional revenue being booked.
You recall, we don't give the forward-looking statements. What all I can say is that we have been creating the order backlog, and we are sustaining this order growth momentum, and naturally the revenue is offshoot of those orders. You get the backlog and you execute it and you get the revenues. And our focus has been, if you see in the last 3-4 years, to consistently create the highest ever order backlog, and this quarter has been highest ever order backlog, close to 19,000 crores.
Got it. I know you don't, sir, good morning. I'm sorry we had more questions, but we're out of time. But I'll just keep it simple. I know you don't give a outlook, but you can agree or disagree, or agree strongly or disagree strongly. So 24, and because it's a high quality name, stocks corrected, and people would want to know, because on a trailing basis, stock seems very expensive. Not your business to talk about the stock, and I don't expect you to. But so 24, I think you did about 120 crores in profits. 25, about 320 odd crores. I'm not. I think that's the expectation. And 26, it's just under 600 crores in net profit. So we're talking about a very big jump in that sense. Sounds in the ballpark, correct?
If the revenue comes up, rest of the things fall in, Prashant. So I don't want to say yes or no for that. If you see here, our 9 months revenue from this year is 4,500 crores. If you add all the 3 quarters put together, which is quite a high, almost 25-26% growth on the cumulative 9 months. I think our thing is to sustain this revenue momentum, and that's exactly what we are looking at it.
All right. Next time I'll ask. We'll ask more in terms of the business. So very interesting space, and of course with the budget around the corner. I think I'd love to have your reaction post the budget as well, which is, of course, this Saturday. Thank you very much for joining us and running us through some of that commentary. We'll take a quick commercial break here. We come back. So lots to discuss commodities with Manisha and more when we return. Welcome back. We've got the market, of course, is doing what it is. Tata Motors is under pressure. It's seeing some pain, some downgrades, etc., coming through as well. In the conference call post the earnings yesterday, P. Balaji, the group CFO, told CNBC-TV18 that the China demand situation is affecting the entire industry at large. He also spoke about their business in the US and UK as well. Listen in.
China demand situation is more coming from some of the retailers getting into financial stress, and therefore that's impacting the entire industry at large. And as the retailer financial situation starts improving, we should expect to see China back to growth in the coming quarters is what I would hope for, and that's what we believe is likely to happen as well. As far as UK is concerned, the main one that we need to plan for is earlier we used to have challenges with respect to getting insurance in the market. That is now behind us. We are now seeing insurance availability for people starting to improve, and therefore I do expect Q4 to be UK starting to normalize. At the same time, we are seeing strong growth for our products in the US because we delivered almost 44% growth in the US, and that should again get back into help us manage some of the pressures that we are seeing, particularly in China.
All right, that's Tata Motors. Stocks been under pressure. Speaking of stocks under pressure, Whirlpool is topping that list, still down 20%. That's because the global parent is looking to cut its stake in the Indian entity. Hormaz back with the details. Hormaz.
Big news coming in this morning, right? Whirlpool now parent company, of course, Whirlpool Corporation, planning to bring its stake down to 20% by the mid of this year or by the later half of this year is what the company said along with its earnings announcement overnight. And at the start of 2024, they had a 75% stake in the company. Then in February, they sold close to 25% stake in that block deal. And now they are planning to bring that stake down further to just 20%. Now, if you remember, in February of last year, there was this 24% block deal that took place that was valued at over 4,000 crore rupees at an average price of just around about 1,280 rupees a share. And Whirlpool Corporation said that they are going to use these proceeds to pare down their debt and to strengthen the balance sheet at the parent level. And Whirlpool CEO, of course, the parent company CEO, Mark Bitzer, was on air on CNBC on the 27th of last year, and he mentioned that they are only taking money off the table with the parent Indian entity trading at around 50 times and the parent company trading at just around at much lower valuations compared to that. And that still stands because even at the current price, the FY26 price to earnings multiple for the Indian entity stands at around 41 times and the parent is just trading at around 9.5 times. And since then, the shareholding changes that have taken place after the promoter pared down stake, mutual funds have increased their stake substantially in the company with the stake that was sold. The stock as well, at that time during the block deal, was trading at around about 1,300 rupees. Within the next 7 to 8 months, it made a high of around 2,450. But if the promoters, the question being whether the promoters have missed a trick, because the stock is now down 35-36% from those levels and add another 20% in today's session as well. So the stock indirectly is now trading below the levels of the block deal that took place in February of 2024. So the street not liking it, another overhang created, the stock down 20%.
Okay, all right. Got that, Hormaz. Thank you very much for the details over there. Let's quickly shift focus to the commodity markets. We have Manisha joining in with the latest. Manisha.
Thank you for that, Survi. Well, these are the markets that are still awaiting clarity as other asset classes as well. So it's ahead of Feb 1st, and we're looking at very choppy markets here. I'll start with what the street is anticipating, and there are various statements on whether or not on 1st of Feb we are going to be looking at those 25% tariffs on Canada and Mexico. If that is happening, is it happening at the same quantum that is being talked about? That is a big uncertainty there. In the meanwhile, when you look at the crude oil prices, we have continued to decline onto this one. We are trading at the lowest level since 2025. For the gold prices, we are not too far away from all-time highs. So all that uncertainty has led to safe haven buying coming in for gold. And when it comes to metals, well, we have seen a decline because the global PMI numbers have been on the weaker side. There are demand fears globally if you do see those tariffs come in. I want to take you visually through on what we've seen in sense of many of these commodities in last few years. I'll start with the crude oil prices, and that big gain came in at 2021, 53% on the higher side. Since then, a plus minus 10%, and and then a plus minus 2 to 3% is what we've seen until now. So all those gains that we saw in 2021 is what we seem to be holding at. After that, we haven't done much. Same is the case really coming in for copper as well. 2021 was a huge year for all of those commodities. So we saw 26% of gains then, a decline, a plus minus 7% and a decline there. So as you can see, after those kind of gains, we haven't been able to see very strong numbers there. Last year, of course, copper saw all-time highs, but since then it has been a one-straight decline. That's aluminum for you, and we are dealing with shortages right now. But even with that, the last couple of years, last year for that matter, hasn't done much. We're looking at alumina, bauxite trading at all-time highs. But has a lot of demand come in for aluminum? We haven't seen that. The huge super cycle that we talk about, or the EV demand in the global markets, clearly hasn't supported many of these metal prices. In case of aluminum also, 2021 was a great year, and after that, we only have seen a decline. Not so much support in last many years when it comes to iron ore and steel. We are looking at constant increase in production there. So as you can see, 2021 was a weak year. 23 we did see some gains, but 24 actually washed all of that out. And this year we've started on a weaker note for this one as well. Final chart comes in for nickel, and while a couple of years were great for this one, since then we have seen volume decline, demand decline, and many of these EV markets actually have moved on to proxies and substitutes. So nickel clearly in oversupply there as well. So many of these metal prices are actually waiting for cues from US in sense of tariffs, better data from China. Until then, this perhaps could just about continue.
All right, Manisha, thank you very much for that. So that is commodities as always, primer there. We take a quick break. It's our special segment. It's the economy. My colleague Lata will be speaking with Stephen Englander of Standard Chartered and Neeraj Gambhir of Axis Bank on the overnight Fed decision and, of course, the upcoming RBI meet next week. Stay tuned.
Welcome back. The US Federal Reserve paused for the first time after it started its rate-cutting cycle last year. The Fed funds rate now stands as before at 4.25 to 4.5. The FOMC statement sounded hawkish, especially when it referred to the labor market conditions as solid and inflation as somewhat elevated. So, where do rates and the US dollar go from here, and what does it mean for the Reserve Bank and for the rupee? I'm joined by Stephen Englander, the head of global macros for Standard Chartered Bank in the United States. And in a bit, Neeraj Gambhir of Axis Bank will also join in to parse the India impact. But first, Stephen, good evening to you, and thank you very much for staying up for us. It must be very late out there. First, what are the key takeaways for you from the FOMC statement? It says labor market conditions are solid. What did you make of that?
Yeah, the statement itself, I think, was more hawkish than last time. And both the comment on inflation, that it was stable above above the target, and the comment on the labor market that it was solid and unemployment was low. It really, if you just took it by itself, you wouldn't think that they would ever cut. But I think Fed Chair Powell clearly sort of massaged that message into something more dovish, and that's why the market is reacting positively.
Okay, I missed that. But how many cuts have you penciled in, or had you penciled in? Have you changed the number because of the statement and the conference?
We think the U.S. economy is weaker than it looks. We think that the data are going to deteriorate as the first half progresses. And so we still have 4 cuts. You can think of that as a maximum. But, given that the market is pricing somewhere between 1 or 2, anything that's 2 or more, I think would be very dovish and dollar negative. So we do think that the inflation numbers will get better, and we think that the labor numbers will get worse within a couple of months, and that will precipitate more aggressive cutting by the Fed than the market is now pricing.
Okay. 4 cuts this year definitely makes you a serious minority. But what is the course of the U.S. yields as you see it? We saw a high of 4.8. Are we, is that behind? What would be the range for the next quarter?
I think that yields are more likely to come down even from these levels, but probably not very much. I think the inflation numbers that we've had recently have looked very benign, so we've already reacted to that, and there was some risk premium that was priced into the market, and that's come out. But we could go closer to 430, I think, on the 10-year, maybe 440. But I think we're not going to see 3 again. And once we actually get to the period of time, likely in the second half, when stimulus hits, I think we'll be trading, well north of 4.5 again. So I think there will be a temporary period of lower yields, but it's not going to last.
See it going below 4.5, that's very important because that will shape what the Reserve Bank is thinking. What's the future course of the dollar index, you think? It went as high as 110 last month, but today it hasn't moved after the Fed statement. Inched up a bit. Stays at 107.8 for the last couple of days. What's the future course?
I think that ultimately the dollar will follow yields and come off. But again, we would characterize this as a correction. We don't think that we've seen the peak of the dollar, but we think we've seen local peaks, and that there's room for the dollar to drop, say 2, 3, maybe 4%, as the macro picture becomes, visibly more benign. But ultimately, we do think that the dollar is going to rebound, that they're really determined to stimulate the economy, and that's likely to renew dollar strength. But we think that's going to be a second half of 2025 story rather than a first half.
Okay, but that's still important. If you're seeing yields higher and the dollar index also higher, that definitely makes life difficult for EM central banks. Now, just a word on US inflation. Given that Trump is serious about tariffs, though he has not announced anything, and has actually done deportation, so serious about immigration, how do you see inflation rising in the US?
Well, it does worry me about inflation going forward, but I don't think it's an immediate threat. I think, again, it'll take a while for tariffs to have an impact. It looks at best that they're going to implement them gradually for the most part. And, I think that for the next 2, 3, 4 months, the inflation picture is going to look much better. The second half could be a different story again, where inflation picks up again. But I think we're likely to go, down to 2.5 on core inflation in the first half of this year. So I think that the Fed and the market will take some comfort from it. But tariffs have a cost in terms of higher prices, and immigration has a cost, or less immigration. I think it will be harder to get people to staff certain kinds of jobs. And But that would be a slow working inflation process. It doesn't mean that it's not for real, but it means that it's not immediate.
Not an immediate threat. Stephen Englander, I really appreciate you staying up for us this late. Thank you very much indeed for joining us. We've got the key things from the US in terms of Stephen expecting that the dollar will continue to remain strong and US yields don't go down much at all. I think around 4.5 is what he was expecting. Let me welcome Neeraj Gambhir, the Group Executive and Head of Global Markets for Axis Bank. Neeraj, thank you very much for finding time for us. Well, Fed has not moved. The Fed Watch tool seems to give the impression of at best 2 hikes, some think even less. Sorry, 2 cuts, some think even less. Do you think the Reserve Bank has much elbow room? What about February 7th itself?
So, Lata, my view is that Fed is on an extended hold. I think if you go through the Powell's, conference call yesterday, it's very clear that there is a lot of uncertainty that they're dealing with, and they have practically no clue as to which way these things are going to play out, right? So I do feel that Fed is going to wait and watch for policies to be announced, study the effect of those policies on the inflation, growth, and various other parameters before they start making their mind about whether the next step is a cut or stay on hold, or maybe a very low probability event of a hike if the inflation doesn't behave well in US. Given that background, I think there is no real pressure from a global monetary policy cycle perspective on the RBI to cut at this point in time. I think the backdrop of a strong US dollar means that we are seeing continuous intervention in the FX market. And that intervention basically means that there is an impact on domestic liquidity. And in that backdrop, and the fact that our inflation is still somewhat higher, we are not seeing as much disinflation in the vegetable prices as was expected. Next year's view on inflation is also of close to 4.5%. I don't see a very real case for a policy rate cut in the February meeting at this point in time. However, there is some conversation about the fact that the growth has slowed down and there has not been as much of a pickup in the second half as was expected. So there are some arguments from the growth side, but I think at this point in time, Reserve Bank can also potentially wait and watch for some more time before taking that step. In any case, the elbow room to cut rates at this point in time doesn't seem to be very, very large. I mean, if you expect the inflation to settle down at 4, then our overnight rate cannot be, significantly lower than 6%. We need to have at least 200 basis points of gap there.
No, exactly. And if the US Fed also is only going for 2 more rate cuts, then they are stabilizing at around 4. The inflation differential between the 2 countries is at least 200 basis points.
That's right.
If it is 4.5, so interest rate differential also cannot be less than 200 basis points. One would assume. Right. Okay, so you're betting on a non-rate cut.
Sorry, on that point, Lata, if you just allow me, if the total leeway that we have at this point in time is 50 basis points, I think the Reserve Bank should potentially keep that for a later date to see how the growth plays out. For example, if the growth weakens significantly from here onwards, then that's the time to use that tool.
Okay. Point taken. But how have you interpreted the liquidity easing measures? Some said that the liquidity has been eased so that when the rate cut comes, it will be passed on. Basically, your takeaways on the liquidity as well as this argument.
Yeah, so I think in the current context of where we are, liquidity is a far more important variable than rates, in my opinion. I think if we need to really be focused on the fact that liquidity in the system is well managed. The banking system is seeing a significant deficit of approximately 3 lakh crores at this point in time, which Reserve Bank has been supplying on a daily basis. But it is having some impact on, for example, the CD market rates, the bulk deposit rates, etc. So we do need longer-term structural liquidity in the system, durable liquidity in the system. What Reserve Bank has done so far is supplied 1.5 lakh crore. That durable liquidity is also being made available over a somewhat elongated time frame. I think it goes all the way up to February end. I think we need more liquidity and more durable liquidity in this quarter than what Reserve Bank has so far supplied. I think my guess is that between 2 to 2.5 lakh crores is the amount of liquidity that we will require in this quarter on a durable basis for markets to settle down and not have too much of pressure.
Okay, I'm being warned this is my last question, so I'm going to pack 3 questions. 1, do you expect a CRR cut? 2, what's your dollar-rupee range, say, for the next 6 months, and the yield range?
I don't expect a CRR cut anytime soon. I think Reserve Bank will try and manage the liquidity situation using the other tools like OMOs and, buy-sell swaps and VRRs. CRR cut is a more blunt and more longer-term tool, so they would probably want to keep it for a later date if required. I do expect dollar-rupee to weaken, but I don't expect it to weaken too much. I think there is the volatility is being managed. There is active intervention from Reserve Bank, so I think 87, 87.5, provided dollar continues to be fairly strong. I think there is some argument for the yields to drip down a little bit more from here. So my range for yields will be somewhere between 6.5 to 6.75 for this quarter.
Oh, thank you so much for packing in so much in so short a time. Neeraj Gambhir, I'll take a rain check from you to speak with you after the budget numbers are out, which anyway people believe is not going to be terribly bond market moving, especially if the borrowing, if the fiscal deficit is going down to 4.5%. Thank you very much for this conversation. We wrap up on Bazaar on that note. Chartbusters coming up.